Holy crap, I literally just got wiped out. This is despite wearing dragon chain armor. Boy, there are lessons in this loss that I really hope that you take with you forever. This is a loss that is really a 99% loss that should have been avoidable. After all, Warren Buffett tells us the number one rule of investing is don't lose money. And the number two rule of investing is don't forget rule number one. Well, I failed on number one and on number two. Now, I was fortunate to sell all of my cryptocurrency and my profitless technology companies or smaller cap companies in January to avoid an additional 70 to 80% losses that would have exceeded the wipeout that we're about to talk about. But the reasons that I got wiped out and this particular investment completely wiped out are big lessons. Now, first, for you to understand this, you need a bit of background. Do you remember the Terra Luna stablecoin meltdown? It was a stablecoin with a value at one point of almost $60 billion. $60 billion is 4 times the amount of money that Cathie Wood manages. It is half the size of AMD. AMD is a $120 billion company. Terra Luna, a stablecoin, got to $60 billion. It's a lot of money. And all of it disappeared. And when that disappeared and that stablecoin melted down, crypto brokerages lost massive amounts of money lending their money to uncertain entities like Three Arrows Capital that just vanished with that $1.18 billion under management and led these crypto brokerages to near collapse, or as some might say, no, collapse. Now, you know what's really sad about this is watch this. Watch this 3-minute clip from March of 2021, 15 months ago, when I described what could happen to stablecoins and companies that I nicknamed like Voyager Digital and CryptoFi. Nicknames I gave Voyager Digital and BlockFi, who are making waves of their own today. Listen to the clip uninterrupted. We think, hey, it's pegged to the dollar. It's pegged to the dollar one to one. And if it's pegged to the dollar 1 to 1, it's kind of like having cash, except it's kind of like a high yield savings account. But that's the problem. It's not. It's a loan. If they made you sign a document saying you agree to lend this and you could lose all of it, people probably would be less inclined to do this. But that's all in the fine print. They just say, hey, sign up and earn interest on your cryptocurrency. It sounds so wonderful. They don't make it clear that this is actually a loan. Now, that doesn't become a problem because right now, your GUSD doesn't fluctuate in value because it's pegged to the dollar and the markets are working normally. Prices are going up. You got nothing to worry about because as prices go up, there usually isn't stress in the markets, right? So when does this become a problem? Well, let's say Sally says, you know what, I'm going to get some margin. I'm going to buy Bitcoin for $100. I'm going to get $25 of margin from Voyager here, and I'm going to have $125 invested in Bitcoin. Now, let's say Bitcoin goes from 55K to 5K. That's a big drop. It's about 91%, right? Well, this is going to go down 90% to about $12.50. What happens now? Well, now Sally gets wiped out. Sally got destroyed. And this could be a flash crash. This could be a day. Sally instantly gets destroyed because you have smart contracts that instantly take her money away, give it to Voyager. The problem is Voyager is left with an asset that's worth a whole lot less than what they thought it would ever be worth. So now they only have $12.50. They just lost money. When a company or an institutional investor loses money, and this happens at scale amongst hundreds or thousands of different client accounts, because we have no idea how many people are on margin. We don't get that kind of transparency. From the system. We don't know. We don't know how often this GUSD is lent out over and over again. We have no idea. Let's say Voyager goes bankrupt. Okay, Voyager goes bankrupt because they're like, wow, we just had all these margin losses. Well, CryptoFi is probably going to have some issues as well, but I'll tell you the first thing that's going to happen. Kevin and Michael are going to be like, oh crap, please let me have my GUSD back. And all of a sudden, we're going to see a lot of people instantly demand redemptions. They're going to want, yo, turn my GUSD into dollars right now. The market's crashing. I'm freaking out. Okay, now, and I know some of you are going to think, Kevin, come on, the same stuff happens in fractional reserve banking. Hold that thought. Okay, I'm going to put a little note down here. Fractional reserve banking. We're going to talk about fractional reserve banking. hold that thought, because there's a massive difference. Quite a few actual massive differences here. So what happens now? Now you've got two people who think they have $100 of GUSD in the bank. They're like, I want to redeem. Okay, well, what happens? Gemini and CryptoFi say, hey, look, we're in a crisis right now. No redemptions. Literally no redemptions. They could do that. It's happened before. Look at Bitfinex. Bitfinex, a Chinese company, uses Tether as their stablecoin, and in October of 2018, they stopped allowing deposits, and so nobody was able to convert US dollars or Chinese dollars or whatever, or euros, into Tether, and the one-to-one peg of the Tether collapsed. It went down as low as 85 cents to $1, and there was no market crash.
Bitcoin was stable around $6,000 when that happened. No crash, no collapse, and Tether loses 15%. Boom, like that. But wait a minute, it's pegged to the dollar. Okay. You think Kevin and Michael are going to be able to go to the Fed and go, yo, I demand my USD? No. Fed's going to laugh you. They're going to laugh you out of the bank. Be like, get out of here. We did not bestow our trust on the GUSD. You tried to inherit trust of the USD. You tried to inherit the sovereign banking, the backing of the full faith and credit of the United States via a stablecoin, but it doesn't work that way. Quick example. I have, let's say, 1,000 of these erasers, and I say, hey, I will always pay you $1 for this eraser right here because the value of this eraser is pegged to the dollar. Cool. Who are you trusting? The US government or me? You're trusting me. If I go bankrupt, worthless. Same could happen here. You get institutional bankruptcies. The value of those underlying coins, which are corporate controlled. This is not government controlled. They're corporate controlled. USDC is a consortium. They're private companies that control USDC. Gemini, private company that controls the Gemini coin. It's not a government. The government cares about the people. Corporations care about themselves.
So I was acutely aware of the danger of stablecoins, so much so that people in the comment sections regular told me that I was just a fudder when it came to stablecoins, that they're always redeemable for either in the case of Terra Luna, 1 Luna, or in the case of things like USDC, $1. Well, today, folks are sending me a lot of tweets saying things like, it looks like your prediction from 2021 may be playing out. And they're showing me charts describing exactly the issue that I explained from the video of March of 2021. Unfortunately, I couldn't even protect myself. Now, for those of you wondering about this chart, with USDC on it, personally, I don't believe that USDC has massive issues until Bitcoin gets closer to sub 10,000, probably around 5,000, then this chart from USDC could play out as well. So there's still more damage to be done to cryptocurrency valuations, but there's something propping up cryptocurrency valuations right now that might not last very long. We'll talk about that as well. But let's go back to me. So what did I do after March of 2021? Well, I did exactly what I said I would do. I would stay away from stablecoins. I'm like, hell no. No stablecoins for me. That is just lending money, and lending money is stupid. See, I come from a real estate background, and my understanding is that when you lend money, you might not get your money back. So I didn't want to be a lender. I wanted to be the broker. I wanted to be involved with like, hey, we'll make you make the loans, but I don't want to be the lender. And this is interesting because not only am I a licensed real estate broker, but I used to be a licensed loan originator, a licensed MLO who brokers loans. And so this kept me researching the issue and looking for opportunities to invest in this market without being in stablecoins. So I interviewed people whom I thought would know better than me. Here's me with the CEO of BlockFi.
We're not building a business that's focused on extracting as much value as we can today or tomorrow. We're really thinking about a relationship with our clients over the next 5, 10, 20 years. And so that's what's important to us. Yep. I think our scale and capitalization and experience in risk management is something that really stands apart from other folks that operate in this market.
Nice. So, yeah, I mean, that's interesting because when the market crashed there in March, there's no Fed coming in to bail out the crypto market, right? There's no lender of last resort. And it sounds like that was almost you guys. So you guys were liquid.
Yeah, I mean, look, we're the largest, and we think of ourselves as certainly a company that's interested in growing more client relationships and offering more products to our clients and being successful from a capitalistic perspective. But we also view ourselves as a company that's an increasingly important part of this crypto ecosystem, and that comes with certain responsibilities.
Here's me with the CEO of Voyager Digital. Would you say then the vast majority of the money that you're lending out is going to these larger institutions that are doing this trading? It's not like, Joe, the ice cream vendor, is getting my Bitcoin, and if it's a cold winter day, he's going bankrupt, I have risk.
Yeah, we don't do any of that. We're straight to these big institutions. It's the risk parameters we've set as a public company. and why it's easy to see it in our disclosures and our financials. You know, we just put out our December financials, got posted on Canadian CEDAR the other day on Monday, as did on the OTC market, so people can see all the data. And like I said, it's only big institutions because we don't want to carry that risk for our consumers.
Here's me with the crypto analyst at Cathie Wood's ARK Invest. Why can BlockFi or some of these other companies, Voyager, whatever, why can they pay me 6% interest just for holding Bitcoin there? Is this BitConnect all over again? Is this a Ponzi? What's going on here?
Yeah, that's a good question. I would say there are a few things. The first is there's a misperception between offering annualized rates and annual rates. So like what's funny is like the 6% annualized, it's at any given time, but you're going to see massive fluctuations that might end up converging towards 2 or 3% over the year. The second thing is that, you know, there is huge custody risk, and people are taking massive risks by custodying it in sort of a counterparty. And so, I mean, we've seen like hacks and leaks and security leaks from users who end up trying to generate yields by going to these more esoteric products. With BlockFi specifically, again, I would say I'm not the perfect person to speak, but I've like followed Zach Prince, who's their CEO, and they've done tremendous things. They're doing they found an inefficiency in the market, and I think because we're so early and crypto first companies aren't actually as integrated into the traditional financial system as what we might see, in a few years, there's still some significant arbitrage opportunities that users are capitalizing on.
And they all told me the same thing. Yes, there's counterparty risk for the stablecoin, but you have to trust the institution. You have to trust how good and protected BlockFi is going to be when we just issue margin calls.
BlockFi, one of the most critical pieces of technical infrastructure that we've built is our risk management infrastructure, which runs 24/7. It's connected to liquidity. And when prices are volatile in either direction, it issues warnings and margin calls and ultimately liquidations to folks who have borrowed from us. And those liquidations occur before the value of the loan is higher than the value of the collateral. So
Voyager lends to safe people like Three Arrows Capital. If there's ever a problem, it's the borrower who will get screwed because they'll just get margin called. And again, I should have reminded myself of what I said in March of 2021, because I even said the words.
Let's say Voyager goes bankrupt. Okay, Voyager goes bankrupt because they're like, wow, we just had all these margin losses.
And now guess what's happening? Voyager got an emergency bailout loan and it's limiting withdrawals from its customers. Like I said, redemptions would get stopped.
They're like, I want to redeem. Okay, well, what happens? Gemini and CryptoFi say, hey, look, we're in a crisis right now. No redemptions. Literally no redemptions. They could do that. It's happened before.
BlockFi got an emergency bailout loan from Sam Bankman-Fried, the founder of FTX, and Terra Luna is at 0. Now, USDC is still fine, but the path to destruction is written. If BTC keeps falling, and my opinion is, USDC breaks as well at BTC 5K. Until then, bailouts from companies like FTX's founder, Sam Bankman-Fried, or Binance can keep crypto afloat. They're basically acting like the Federal Reserve, which, remember when I said you're going to wish you had a JPOW, who's referred to as the lender of last resort? Well, guess what CNBC is now calling the founder of FTX? Yup, the lender of last resort, just like JPOW. But even Sam Bankman-Fried doesn't have a money printer like JPOW. So that means his support is more limited than what JPOW can do. Sam Bankman-Fried might be able to help prop the crypto economy up around 19,000 Bitcoin as a strong support. But what happens when his support stops? What happens when true panic spreads? Because there's no Sam Bankman-Fried to make sure Voyager Digital can allow people to at least remove some of their money from the platform. TBD. But how did I get wiped out? Already! I couldn't even make it to the end. And I was the one ringing the bell of the warnings. So how the hell did I get screwed? Well, after talking to the CEO of Voyager, BlockFi, and other crypto analysts, I thought the safest investment was in the institutions. The worst case, the people lending their stablecoins would get screwed, but the brokers transacting it would be fine. You lend the money, a lender gets screwed. Broker still keeps the commission. Well, that real estate style thinking got me wiped out because in May of 2021, I agreed to invest in BlockFi as a venture capital investment. I invested $420,690 into BlockFi, which is more than other people invested when they say they did things like starting a bank or buying a bank. You could do that with little investments like 25, 50, 100, 200K. No, I didn't even talk about my investment, and I've still put $420,690 into BlockFi. Here's my wire. And CNBC just released a wonderful article saying that BlockFi is now in such distress because of the Three Arrows Capital margin call and that margin call not working out and that good old risk management from BlockFi not working out.
So, I think our scale and capitalization and experience in risk management is something that really stands apart from other folks that operate in this market.
BlockFi is now being sold for less than 99% of its prior valuation, potentially all to Sam Bankman-Fried for just $25 million. And all the venture capital investments are wiped out. Well, folks, it looks to me I can pat myself on the back. I was 100% right. My fundamental analysis was absolutely correct, except I still lost everything. These are laughs of pain. See, 3 things went wrong. This was a venture capital funding, which meant I had no liquidity. I wanted to be liquid in crypto, so I tied myself up into venture capital, which has no liquidity. See, once you're in a fund, you're locked up. In fact, I regretted my decision as early as September of 2021 when I grew more concerned about stablecoins. But I was told that my money wasn't in shares themselves, that I just had ownership interest in a fund that owned the shares in BlockFi, and therefore I could not sell my shares on Equity Zen, a place you can sell shares. Number 2, I ignored the collateral damage that would occur if my stablecoin belief was correct. This was a huge blind spot. I was correct about stablecoins collapsing, but didn't realize that they would take the ship down with them. This was a large blind spot, and I paid the price dearly for that. Number 3, I didn't follow up on the red flags of the companies being able to explain their yield strategies. Numerous times in interviews, I complained that it just seemed odd that they were able to pay people 6 to 10% on stablecoins, yet they somehow weren't taking larger risks elsewhere. Well, by being blind to these 3 issues, I couldn't even save myself.